Hello YouTube, back again with another video. We are still in the June commentary, and for this commentary, majority of the time we're going to be talking about intraday price action. And with this particular video, I want to emphasize the ICT price action. I want you to be familiar with the market structure that I'm using. So this is that video where I talk about price action in general. It hinges upon your aptitude for learning the ICT strategy. You need to pull up your sleeves and jot down some notes in case I say something that is noteworthy. I wanted to touch on the trading schedule that we will be implementing in this year's commentary. I will be dropping a video in the beginning of the week, maybe like Sunday, Monday, Tuesday, and in the middle of the week as well. I will drop another video in case I see something that resonates with my strategy, then you will know about it. All right. So that's it. Let's get into step index on a daily time frame. The first video that I had, if you can clearly see, the candlesticks are a bit different. So you need to be mindful of that. I have a problem with the platform of TradingView. The candlesticks are giving me a problem, especially on the higher time frames. I am mostly on higher time frames. This is where we start our analysis. So I'm going to be relaying the ICT core concepts. So you need to jot down some things that I will be talking about, especially in this video. So what is the framework that I am using to have a directional bias? So the very first thing that you need to focus on when dealing with ICT's concept, you need to start at the core. And the way that I learned how to trade ICT was to delve deep in the ICT PD array matrix. Now we start off with a dealing range. When you are talking about the ICT PD array matrix, we are essentially talking about a dealing range. So what is a dealing range? It is defined by two anchor points, a significant swing high and a significant swing low. This is categorized by a 3-bar candlestick pattern, which is synonymous with a liquidity sweep. Okay, I will give you a visual representation of that. Let me zoom in on this consolidation, right? So initially, before price action created this run up, we had this particular high, which is our swing high, our significant swing high, which has a 3-bar candlestick pattern. It has a candlestick in the middle, which is higher than the one on the left. As you can see, the one on the left has a lower high, and the one on the right has a lower high as well. So this makes our swing high. A swing high is synonymous with a liquidity sweep. When we're talking about a swing high, we mean that price action went up into some inefficiency and it went up to take out the buy side liquidity as well. So price does two things. It does take out the buy side liquidity here, and it trades into the inefficiency. Now it goes lower all the way up until the June 5th. This is where we created the swing low. We sweep the sell side liquidity pool here. We create this particular wick. Our swing low has a 3-bar pattern as well. It has a higher low on the left and a higher low on the right. This higher low on the right is higher than the candlestick in the middle. The candlestick in the middle will always be lower than the one on the left and the one on the right. So it's a 3-bar pattern. It is synonymous with a liquidity sweep. It sweeps out this particular low. So this is our dealing range, high, and dealing range low. Inside of our dealing range, we can also apply price gradients. This is where we have our ICT support and resistance. That's what we normally use for support and resistance ideas. So how does it look like? Well, we need a Fibonacci retracement tool. We place it on our swing high right here and our swing low. Now these are the price gradients that we have. Okay, so I'm going to reverse this particular Fibonacci tool. Above the 50%, it is premium. And below the 50%, it is discount. So we have our dealing range high and our dealing range low. We have our price gradients, which is the 25%, right? So the 25%, this is where you are most likely to find a support. Since price is in a discount, you would be looking for ideas for price action to run up into the premium. We are talking about price action before this particular high was formed, okay? I was supposed to drop this video yesterday, but yesterday we had this Thursday candlestick running up into the buy-side liquidity. So I had to wait for this particular candlestick to close. I wanted to see if it's going to close above this high or the way that it closed, just below it. Okay, so that is external range liquidity. And down here in the 5th of June's low, we have another external range liquidity. So what is the liquidity inside of our dealing range called? It is called internal range liquidity. Okay, so this high that was printed on a Sunday, as we know that Sunday begins our trading week, it is the beginning of the week. So Sunday we created this high at the 75%, and since it is at a premium market, we expect price action to sell off if it is above the equilibrium. And as it got down here, it printed the Monday's low near the 5th of June's low. And this is our Tuesday. This is why I say I'm going to come in the beginning of the week, Sunday, Monday, or Tuesday. I will be there to drop a video so that we are familiar with the highs and lows of the week. So we have this high that is printed at the 75%, and price went lower to print more sell side liquidity near the 5th of June. So it went up to attack the external range liquidity. So if it is trading above that particular swing high, we expect price action to break out of this consolidation. That's what we are expecting. But if it is breaking above it, but does not close above the swing high, what does it mean in terms of order flow? It tells us that it does not want to continue going up. So that's what I'm getting at in terms of the ICT market structure. This is how we confirm a failure swing. A failure swing, even though it takes out the external range liquidity high, it does not close above that particular high. So it means that the relative equal lows down here are going to be the draw on liquidity. Draw on liquidity refers to where price is likely to go. So the relative equal lows, they are down here. Tuesday's low and the 5th of June's low. This is the draw on liquidity. We are way up there in the premium. So this is what we're going to do. We're going to take our swing high and we're going to place it right on top of our new dealing range. So this is the dealing range that we have now. So we are above the equilibrium. We expect price action to do what? To sell off. If price is at a premium, we expect it to sell off. Take it like resistance and your support. When price is near the support down here, we expect it to rally up. So we had taken out the external range liquidity. And if I look at my time, it's been 8 minutes since our PM session had begun. Okay, so I'm going to drop down into the New York time zone, and I'm going to head over to the 1 minute time frame. Remember the price gradients that we did on the daily time frame? That is going to be of significance because those key levels are the support and resistance ideas that we are utilizing. Okay, so I'm gonna indicate the time separators because they are very important in our discussion. We're gonna have our time separators which separates the days. So I'm gonna give you the daily range of today. We're gonna zoom in on the London session. I know you guys want to trade the London session, but for me, I am not available for the London session. When the London session begins, that's when I am going to work. Okay, I'm in transit going to work. So I'm not available for the London session. So today, I was expecting a bearish day since we know that we have a failure swing. The candlestick of Thursday did not close above that swing high. So that is bearish. So today we have a bearish bias. I want you to keep that in mind. So we have a bearish bias, but how can you frame it into a possible setup? So number one, it is time. Time, we have our sessions, okay? So I'm going to drop down into the 130. 130, that's when we begin the opening range for London. It is 30 minutes. So from 1:30 to 2 o'clock, that is our London opening range. If I unzoom a little bit, just a little bit, we have this trend line phantom, which is against our bias. So whenever we have these trend lines in the marketplace, that tends to, be some kind of diagonal support. I am looking to attack these particular lows. That's what we do in the ICT community. Okay. So since we know that we have this diagonal support, which is basically liquidity, other traders are looking at the Thursday's price action, and the Thursday's price action, which was a bullish day. It was a bullish day, as you can see. It rallied. So of course, we would have these higher highs and higher lows type of formation. And these higher highs and higher lows formations, they make up some kind of a trend that is seen with these diagonal support trend lines. I don't trade trend lines. I attack trend lines, okay? That may seem a little bit brutal, but it is what it is, man. All strategies cannot work in the same way. So the strategy that I am most familiar with is ICT. Okay, ever since I started trading in 2019, I've been trading ICT price action. Now, my knowledge of trading ICT has expanded. Hence why I'm now an educator teaching you about the price action that is repeating here every day, every single day. This repeats. So we are looking at the 1 minute time frame framework. We are going to frame a setup. The setup requires some form of liquidity to be taken. we have this buy side liquidity. These are relative equal highs. We have our London opening range, which begins with a fair value gap. So I'm going to extend the fair value gap that formed in the opening range. I'm going to take it from the high down to the volume imbalance. It has a volume imbalance. So this is the candlestick low. This is where we have our fair value gap high. And on this candlestick high, this is where we have our fair value gap low. I know that may sound a bit confusing, but this is the fair value gap high and this is the fair value gap low. In the middle, we have the consequent enroachment. So right off the bat, the market uses the fair value gap as a bearish structure, right? It prints that trend line phantom low, and a lot of people are buying this trend line, okay? The trend line phantom, this is what it is. In London session, everybody is looking at this trend line and they are going long, okay? They are going long with it. But I am not looking for longs because I know that we have a failure swing high on a Thursday. So today it is supposed to be a bearish day. So the first thing that needs to happen in London session, we need to take some form of buy side liquidity. So price action utilizes the London opening range fair value gap initially as a resistance, and it gets above it and it comes back to treat it as support. That can be a beautiful long position to attack the buy side liquidity. And of course, I'm not bullish, I am bearish, but you can still take this long and go up with it to take out the buy side liquidity pool here. So here you are, you're going long right here, and you're going to utilize a 3 point of a stop loss. 3 point of a stop loss, you can take out these buy side liquidity pools. Okay, so the buy side liquidity pool has been taken, and price action leaves this fair value gap open like this. We call this a breakaway gap. Price action drops lower, creates this consolidation, and eventually it gives out the ghost and it goes lower. It closes below the London opening range fair value gap. Now, when we come back, we want to utilize it as an inversion fair value gap. An inversion fair value gap, initially, we utilized it as a support to go higher to attack the buy side liquidity. So everybody who was long in the London session, they were cooked. After this high was taken, price went lower below the London opening range fair value gap. And below that London fair value gap, that is when you can anticipate bearish structures. Okay, so we had price action moving away pretty quickly. Okay, so we had the 5 a.m., 5 hours into London session, we have what we call the London lunch. And as we can see, the London lunch continues going lower. Shortly afterwards, the New York session opens, and we're gonna have our 7 a.m. is right here. This is where we open our New York opening range. So it is 30 minutes as well, from 7 o'clock to 7:30. Within this time frame, we are expecting a bearish fair value gap in our bias. We are bearish. The buy side has been taken. The trend line phantom has been vaporized. So in the New York session, we are expecting a continuation. So let me zoom in a little bit. Here is the New York fair value gap. Okay, let me zoom in a little bit so that you can see clearly the inefficiencies that are there in the New York session. So I'm taking it from this particular candlestick low, and we have this tiny fair value gap. But below it, we also have another fair value gap. So I'm going to take the entirety of these two inefficiencies. So since this is a New York fair value gap, it is going to have an orange color. Green colors, if you're seeing green colors in my chart, that is the London session. And if you're seeing an orange color, that is the New York session. So right off the bat, the New York session utilizes that fair value gap as a resistance. That is a beautiful trade. So where is the sell side liquidity that we can use to target? We have the 75%, and in the 75%, we have all of these sell side liquidity pools that are congested together. So that is your sell side liquidity that you could have targeted in the New York session. All right. So price action returns into the 10 a.m. If I unzoom a little bit, the 10 a.m. price action today, it creates this particular low, which is very close to the 5 a.m. of Thursday. 5 a.m. Thursday is London, so it's going to be a green color. So green colors, that is the London session low. So 5 a.m. yesterday of London, we created this low. And here's our 10 a.m. dropping down to take out the London low. So I would say that there is some kind of liquidity 10 a.m. and 5 a.m. This is time-based liquidity. So after our 10 a.m., we retrace all the way back into the New York opening range fair value gap. So as long as we are below these two fair value gaps, we are permitted to look for selling opportunities. Okay. So let me zoom in our PM session. This is our first PM session, by the way. This is beautiful. So our inefficiency is right there, right off the bat. We are seeing that the PM session opened with an inefficiency. So I'm going to zoom in a little bit. I'm going to show you the PM session inefficiency. So it is somewhere right around here. Do we have an inefficiency after 1:30? Nope. We don't have an inefficiency with this particular run to the upside, right? We have a volume imbalance in here, but that's not our fair value gap. Our fair value gap forms right here. And as you can see, we just went below that particular inefficiency rather quickly. So we just created a market structure shift. So what would we be waiting for? We would be waiting for price action to come back into the PM session opening range fair value gap, and we're going to utilize a 3-point of a stop loss which covers this particular high. So if price action were to come back and invalidate this particular fair value gap to the upside, that would mean that the trade is wrong and we are offside. So we would need to mitigate that particular loss before our stop loss is taken. This is why I love trading ICT, because I can mitigate a loss if I can see that a structure has been invalidated. So I'm going to add this particular inefficiency into my analysis because it is very important as well. It overlaps with the New York PM session opening range fair value gap. So I'm going to grab that particular volume imbalance and I'm going to copy it and paste it right here. So I can have my entry like this. from this particular inefficiency, my stop loss is still 30 points. It is above this particular high. I am still safe. So I'm just going to be waiting for price action to come back into that to offer me a beautiful short setup. So remember the 10 a.m. and the London session low. That is where I'm going to take profit. This is really, really beautiful setup, guys. The PM session, this is what I would trade. So this is it for my introduction to ICT concepts. I know that was a little bit fast, but hopefully I will have more setups to show you how to utilize ICT's framework to frame a possible setup just like this one. So I'm going to leave the market running like this. Okay, I'm just going to leave it running like this. Let me take my take profit to the 10 a.m. 10 a.m. We associate that with an orange color. And this is our 10 a.m. Orange color means that it is New York. Okay, New York session, London session. London session is green. So here is right around 15 points. That's a beautiful scalp. That is a beautiful scalp. So I'm going to leave it like this. And it's just going to record. I'm going to fast forward the price action that happens so that you can see how to utilize ICT concepts to frame a beautiful short setup. So here it is inside of that fair value gap, and I'm going to leave it running. I'm going to see you at the results of this particular trade. Enjoy. So if I had used a 0.10 lot size with a 3 point of a stop loss like I was indicating here, I would have a loss if this trade were to go against me and go to my stop loss with 0.10 lot size. I would lose $3. A point is $1 with a 0.10 lot size. So 3 points is $3. If I were to utilize 0.20 as my lot size for this particular trade, then my stop loss, it doubles to $6. 3 points. This is why I like to use the intraday opening ranges fair value gap, because they allow a tight stop loss. I have to say this, I am not enticing anyone to trade the way that I trade, but I just want to say that utilizing the lower time frames like the 1 minute intraday price action, it really reduces the risk of trading. Normally I target 10 points. So if I'm utilizing 0.50 and I am targeting 10 points, that would take me to a $50 of a take profit. So that is a game changer. You're coming into the session where you are available, no distractions. Take it serious. Come to the charts when you are fully available. if you don't do that, you will have half-baked results if you don't follow this trading schedule properly. So this is it for me. I will see you guys on the next video.